Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that has just been on a relentless move very recently over the past few weeks. We've seen price grind up back to the all-time high in a parabolic fashion here. In this video, we're going to discuss whether or not that's sustainable, what we can expect from the stock market in the short term. We've made a few videos discussing the longer term outlook. We think the bull run isn't over and there's plenty of room for this big speculative market to continue higher, but perhaps that's a different story in the shorter term time frame. So that's exactly what we're going to cover in this episode. If you're interested in following these markets with us, make sure to smash that subscribe button. We post videos multiple times a week on the stock market, on how to navigate it, what the tools we use for our research and analysis are, and what goes behind our thought process to navigate this market. Now, without further ado, let's get right into it. Alright, so I want to begin by taking a look at the bond market. This is the TLT ETF, the Treasury Bond ETF. We've been looking at the technical picture on TLT and waiting for a bounce as it was approaching support. We talked about this $140 level. We discussed that towards the beginning of October as we had TLT come down to that level of support. And since then, we have had a little bit of a bounce here. Now, again, I just want to remind you guys that the pessimism around the bond market is extreme right now. And that's incredibly important to keep in mind. We like to stay away from the herd. We like to have a contrarian outlook on the market. And so seeing this type of reading in the fund manager survey, that tells us we could see a little bit of a run on bonds. And that seems to be what's happening right now as the bond market is rallying off support. Now, why do we look at the bond market? Because it has such an impact on the markets. It has two big impacts. First of all, the inverse correlation between the bond market and the stock market, right? This is something we talk about a lot on this channel. If you want to know where stocks are going, you have to look at bonds. When bonds go up, stocks typically go down. And when bonds go down, stocks typically go up. Just to quickly show you what I mean, this is a weekly chart showing you the S&P 500 and TLT. Look at that beautiful inverse correlation between those two charts. Now, the second thing to understand is that when bonds are rallying, that typically means that yields are coming down. As bond prices go up, yields go down, right? And so you can take a look at, for example, the 20-year yield on government bonds. You have a perfect inverse correlation between bond prices and bond yields. So if we expect a bounce on the bond market or a rally in the bond market, what does that mean for the stock market in the short term? Well, first of all, it's going to mean that tech is going to outperform. And that's exactly what we've seen over the past few weeks. Ever since we had that bottom in yields, I'm going to show you the 10-year government bond yield here. As we saw yields rise here, we saw tech come down. And now that we're seeing a little bit of a consolidation, you're seeing tech make a nice run up here. Now, the problem I see with that is that that run has likely run its course. We've had a tremendous performance on the technology sector throughout the month of October, and now we're coming into a zone of resistance. We're only a couple of percentage points away from resistance, right? The NASDAQ 100 is getting into that upper end of that range, and so we can't have that bullish bias that we had a couple of weeks ago, where we were talking about the fact that if we see a rally in bonds, that's typically bad for stocks, right? Seeing bonds rise and yields fall, that's typically bad for stocks. But tech was just so beat down back then that it was also possible to make the argument that a rally in bonds and so yields falling would mean that tech would bring up the market. And that's exactly what happened over the past few weeks. This recent rally in the bond market has brought tech higher and pulled the rest of the market higher. But that's just not going to be the case anymore. Most of this run has probably run its course. We could have a little bit more upside, but very limited in terms of how much it can pull the market higher. So that's the first warning signal that I'm seeing right now for the short term in the stock market is that if we have a rally in bonds, it's not going to push tech much higher, and it's actually going to have a negative impact on sectors like the financial sector or the industrial sector that's currently at resistance. These are sectors that perform well when the yields are rising. So if we have a rally in the bond market right now, we can expect industrials to reverse off this resistance. And remember, these two sectors, financials and industrials, make up almost 20% of the SP 500. You've got tech nearing resistance, so that's 60% of the S&P 500 that has limited upside and potentially a lot of downside in the short term. Now, before I get into one of my favorite charts of the week and discuss the recent plunge in inflation expectations, I want to quickly talk about the VIX right here. The VIX is such a powerful tool to understand what's happening with the stock market. And this is just another small little signal that's caught our attention recently, and that's perhaps shifting our bias a little bit less bullish. First of all, the VIX is at support. We're very close to this 14 to 16 point support zone right here on the VIX. That's typically where you start to see a little bit of volatility acceleration, right? While we were extremely bullish in this zone here between around the 20th of September and beginning of October, where you saw a rise in the volatility, you had the stock market begin to make a bottom. This is typically when the risk to reward ratio is the most favorable for the stock market. So when you have the VIX at resistance, we were at resistance here, that tells you, all right, that's a nice place to be entering the market. Same thing right here, great entry. Same thing here back in October 2020, great entry. June 2020, great entry. But these zones here that I'm highlighting were not particularly good entries. In fact, they were poor entries. If you look at it in terms of the short-term price action, you did have little corrections after you had the VIX test support. So that's the first thing that I want to show you guys. VIX has tested support. And the second little development here that has our attention, you can see what's been happening over the past few trading sessions. Just a few days, we had the VIX rising here. And seeing the VIX rise as the stock market is rising is an unusual development. Typically, when you have the stock market rising in a healthy manner, like right here, you have the VIX coming down. But when you start to see the VIX rise as the stock market is rising, like you had right here between the 9th of April 2021 to May 2021, you had that type of move. It told you were going to get a small correction. That's exactly what happened. You had the same thing in this zone here. You had the VIX starting to rise and the stock market rising with the VIX. This September top here in 2020 is another great example of that. You can see the VIX is rising here leading up to the 1st of September, and you have the stock market rise at the same time. It typically doesn't last very long, but it often leads to a correction. Not always, but frequently. For example, here you had the stock market rising, VIX rising, didn't lead to a correction. So keep an open mind to all outcomes. Now, this is really the whole idea behind the service that we provide at gameoftrades.net. We try to give you guys the full picture on the equity markets, whether that's the short-term price action throughout the next few weeks, or what the broader macro environment is, whether we expect the bull run to continue throughout the next few months, looking at market internals, volatility, market health, breadth, and really just assessing whether or not the risk reward is good on the stock market right now. Short term, it's bad. That doesn't guarantee we're going to get a correction. It just means it's not an ideal place to be entering the market like it was throughout this period. This is really not a particularly easy environment to navigate. It's very easy to get caught up in your emotions when you see a breakdown in the technical structure like we had back here. It's easy to get bearish even though the risk reward is extremely favorable. And when you see a big move up like this and it in a parabolic type of move, very strong price action, it's very easy to get the FOMO to start to flip to bullish and to enter at the top. So that's really the primary objective behind our service, is to try and keep your head straight through the frequent articles that we make on the stock market, the videos that we put out. We try to keep a contrarian outlook on the market and actually look underneath the surface to see what's actually happening, not giving in to just this bullish price action. So again, if you're interested in getting more content to follow the markets with us, follow our research, follow our analysis, and join our community on gameoftrades.net, don't hesitate to grab a free trial. You can test out our service, and I'm sure that you guys will not regret it. Now, as I said a couple of minutes ago, getting back into the video, we have the inflation expectations ETF here, RINF, that's been crashing down very violently over the past few days. This is an interesting development. And again, going back to what I was saying about the bond market at the beginning of the video, this is good for bonds, right? To see inflationary expectations come down, that's good for bonds. So that increases the odds of seeing more upside on the bond market and seeing that short-term scenario that we talked about on the stock market potentially play out, especially as we see assets like lumber, right? Lumber has been crashing down recently. Lumber is a great leading economic indicator. We love to use lumber because it's a real-time indicator of housing demand. So if lumber prices are strong, that's a really early signal of strong housing demand, and so it's an early signal of a strong economy. So seeing lumber prices come down here, not such a good news in terms of the intermarket analysis, perhaps warning a little bit of a risk-off move here. Now, I do have a very interesting chart to show you guys regarding this topic on inflationary expectations. We wanted to actually look at what the S&P 500 looks like when it's put into proportion with this ETF. And it gave us some very interesting results. If we take the S&P 500 and we divide this chart by that ETF, the inflationary expectations, it gives you how the stock market is performing relative to inflationary expectations. And it's more or less a steady line since 2013. In fact, we have some pretty clean technicals on this chart. This actually came to a surprise, but look at this beautiful channel capturing all these nice reactions in 2016 and 2017. These big reactions, 2020, 2021, and quite a few bottoms as well, capturing these support levels. So you can say that this is a clean level of resistance on this ratio between the S&P 500 and inflationary expectations. Now, again, I don't like to base our entire strategy on one indicator. That's not how this works, but you can have different little pieces of the puzzle, put them together, and it gives you a broader outlook. And if we look at this chart, we're currently at resistance like we were back here in August and like we were back here in August 2020 and February 2020 as well. If we look at the S&P 500 on top to see what these moments correspond to, obviously that was the COVID crash that triggered the September correction, and that triggered the recent September correction we had. Now, I don't see this ratio breaking out above this channel here, although anything is possible. This tells me we're currently at resistance, and considering the bond market rally that we're expecting, the recent big tech rally that we've seen, and the VIX that's currently at support, all of these short-term signals are telling me that this run that we're seeing might come to an end, and we might see some short-term volatility, potentially taking us back down to the bottom of this channel. That'd be a 4 to 5% correction. Nothing major, but definitely something that you want to avoid by not entering at these levels. Now, of course, this doesn't change anything in our broader stock market outlook. We continue to expect the bull run to resume higher. Stocks are still incredibly attractive relative to long-term bonds. And as long as that's the case, we can expect equities to perform well. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button. Now, in the meantime, I wish you good luck on your trading and see you next time.